Chapter 6, Merchandise Inventory. There are several principles upon which the foundations of accrual accounting are built. The first of these principles is called consistency. The basic principle states that even though companies have choices with respect to the accounting principles they choose to apply, once these principles have been chosen, they should use the same principles from one period to the next unless there is some compelling business reason to change. And if they do change the accounting principles that they have been applying, they should communicate those changes to their stakeholders, or really anyone who's looking at their financial statements. The disclosure principle states that a company should disclose sufficient information to their stockholders and creditors to allow those people to make informed decisions about resource allocation. The materiality concept states that companies need not report every single penny. In essence, the concept recognizes that the size of the dollar amounts of transactions are most relevant when compared to the overall size of the company. For example, a $1 million transaction is very relevant to a $10 million company because it represents 10% of the company's value. However, to a billion-dollar company, a $1 million transaction is probably not large enough by itself to impact the decision of a stakeholder or creditor because it represents 0.1% of the company's value. That's not to say that that $1 million transaction is meaningless, just that whether that's a good $1 million transaction or a bad one is probably not going to make an investor or some other user of financial statements change their mind on whether or not to invest in the company, just based on that dollar amount. Conservatism is a principle that states that when a company has a choice between different accounting treatments, the company should always choose the accounting treatment that is least likely to overstate assets or net income. At the end of each fiscal period, there are two accounts that reflect information about inventory: merchandise inventory and cost of goods sold. The number of units in merchandise inventory at the end of the period can be determined by physically counting the amount of inventory owned by the company at the end of the period. The number of units sold during the period will be determined and then multiplied by the per unit cost of the inventory. When the cost of the inventory does not change during the month, the assignment of dollars to ending inventory and to cost of goods sold becomes a fairly easy exercise because they all cost the same to the company. Simply multiply the number of units on hand by the cost per unit. Likewise, multiply the number of units sold by the cost per unit. When the cost of acquiring inventory does change during the period, then it becomes more unclear with respect to how much cost should be applied to each unit in ending inventory. Basically, there are four approaches that are acceptable for generally accepted accounting principles in computing the amount of dollars to assign to ending inventory and to cost of goods sold. Those methods are 1. Specific identification, 2. First in, first out, or FIFO, 3. Last in, first out, or LIFO, and 4. Weighted average. That's a typo there on the slide, last in, last out for number 3. That should say last in, first out to correspond with the acronym LIFO. Specific identification is dependent on being able to identify the specific costs associated with each individual item in inventory. This is most efficient when each item in inventory is unique and has a unique identifier. Examples include automobiles that have a unique vehicle identification number or VIN, or one-of-a-kind pieces of artwork. Real estate fits into this category because no two pieces of land are exactly the same, and expensive diamonds that have an ID number engraved on the bezel of the stone. Basically anything that's either a small enough quantity that you can easily keep track of each and every one, or there's some specific identifier that makes it fairly easy to determine which individual item was sold. Assume that we have a hypothetical company that begins the period on August 1st with 2 units in inventory that cost $350 each. On August 5th, they acquire an additional 4 units of inventory at $360 per unit. On August 15th, 4 units are sold. Assume that the units are individually identifiable and that we know that one of the 4 units sold cost us $350, and the other 3 units sold each cost $360 per unit. On August 26th, an additional 12 units are acquired at a cost of $380 per unit. On August 31st, 10 units are sold. We are able to identify that one of those units is the remaining $350 unit, and that the rest each were units costing $380 per unit. In effect, each time there is a sale, we remove from inventory only the cost that is specifically identified and traced to the individual items that were sold. In perpetual FIFO, we will account for each purchase and sale as it happens. When we sell items, we are usually unable to identify which specific item we have sold, since they are all the same, or homogeneous. For accounting purposes, we will assume that the units sold were the oldest units in inventory at the time of the sale. We will remove the oldest units along with their cost from the inventory record, leaving the newest units available. This is kind of similar to the idea of when stocking a shelf, putting the oldest units towards the front of the shelf, because theoretically those would be the units that are sold first. That way, as you move backwards into the shelf, you are getting newer and newer units, and the older units are going first. However, this perpetual FIFO, it doesn't really matter whether that actually happens, that the oldest units are going first. We're just assuming for accounting purposes that that is what is happening. In our example that we already talked about, August 1st beginning inventory is 2 units costing $350 per unit. August 5th, 4 units are acquired at $360. August 15th, 4 units are sold. We will assign the first 2 units from beginning inventory along with their cost to the sale. Then the other 2 units will be assigned from the August 5th purchase, leaving only 2 units after this sale occurs in inventory, each with a $360 cost. On August 26th, there's 12 units of inventory purchased at $380 per unit. And then on August 31st, we sell 10 units. Of those 10 units, 2 were the remaining units costing $360, and then 8 units will be from the most recent purchase costing $380 per unit. In perpetual LIFO, we will account for each purchase and sale as it happens. When we sell items, we are usually unable to identify which specific items have sold, just like we said in the last example, since they are all theoretically homogeneous. For accounting purposes, we assume in LIFO that the units sold were the newest units in inventory at the time of the sale. This would be the equivalent of stocking shelves at, say, a grocery store and just pushing all the older units back to the back of the shelf and stocking the newest units up in the front. That way, theoretically, as someone goes by and grabs a unit, we are selling the newest units first, and only if we sell to the end of our inventory do we ever get to the oldest units. Again, it doesn't really matter whether we are actually selling the newest or oldest units first, just that for accounting purposes, when we record costs, we are assuming or pretending that the items that we most recently purchased are the first being sold. In our example again, we had two units starting out the period at $350 each. We purchased 4 units at $360 on the 5th. On August 14th, 4 units are sold. In this case, we assume that all 4 of those units are the ones that we most recently purchased, leaving the 2 original units in inventory still in inventory as we continue on through the month. On August 26th, there's 12 units purchased, and then on August 31st, we sell 10. Of course, since our most recent purchase included 12, and we just recently sold 10, all 10 of those units will come from the most recent purchases. that would again leave the original 2 units in inventory plus the 2 units left over from the most recent purchase in inventory. The perpetual weighted average approach recomputes the weighted average cost per unit each time new purchases are added to inventory. When units are sold, they are removed from inventory using the weighted average cost at the time of the sale. When new purchases are added, the weighted average cost per item will change again and will become the new weighted average cost that will be used for the next sale. So basically, every time that you purchase inventory, you look at what's already in there and the cost assigned to the inventory already in there, you average that together with the new stuff that you get, and you have a new weighted average. And then it doesn't matter first, last, whatever, we're assigning the same cost for every unit we have in inventory at the time. To compute weighted average cost per unit at any given point in time, simply divide the dollars currently in inventory by the number of units in inventory. Again, each time new items are purchased, the weighted average cost per unit will have to be recomputed. However, when units are sold and removed from inventory at their weighted average cost per unit, the number of units may decline, but the weighted average cost of the remaining units will remain the same. In our example, again, the weighted average cost on August 1st is $350 per unit because we have 2 units, $700 total in inventory. When 4 units are purchased on August 5th at $360 per unit, we now have $1,440 added to inventory because 4 units were added at that cost, and there is now a total of $2,140 worth of inventory in there, and that is that cost is divided over 6 total units, leaving after that first inventory purchase a weighted average of $356.67 per unit. So on August 15th, when 4 units are sold, that is the price per unit that we assign to each of those units. This leaves $713 worth of inventory divided between the 2 units left over. Again, same weighted average cost after that sale because each item we sold, we assign that average cost to. Then we add 12 units at $380 each for a new total of $5,273 in inventory, including those 12 units at $380 and the 2 units we had left over at $356.67. We will now divide that number by 14 units, which is the amount of units we have, and the new weighted average cost per unit is $376.64. And that is now what we would use anytime we sold any inventory from now until the next time we added new inventory. When we compare the results of FIFO, LIFO, and weighted average, we can see some patterns that can be useful to our understanding of financial statement results. First, we see that in this case, FIFO gives us a lower cost of goods sold and a higher gross profit than either LIFO or weighted average. Also, we see that LIFO gives us a higher cost of goods sold and a lower gross profit than FIFO or weighted average. Weighted average gives us a cost of goods sold and a gross profit that is somewhere between LIFO and FIFO. The relationship that we observed with our inventory example will be true anytime that costs are constantly increasing, which is usually the case. When prices are constantly decreasing, which is less often, the relationships will still exist, but they will be the opposite relationships. Even after we have used one of the inventory methods to determine the cost of the inventory and the cost of goods sold, there is a limiting rule in accounting called the lower of cost or market rule, or the LCM rule. Under the LCM rule, the final carrying amount of the inventory on the books will be the lower of the cost as determined using one of our inventory methods, or the market value of the inventory. In some cases, inventory will decrease permanently in value while it is being held by the company. For example, a new product may be introduced by a competitor that makes all existing inventories obsolete. In such cases, the market value of the inventory on hand may actually be lower than its original cost. In those cases, we will down adjust inventory to the lower amount. In this example, the inventory has a cost of $2 million. However, the market value of that inventory is now only $1.2 million. There's a need to write down the inventory to $1.2 million because the LCM rule tells us that inventory must be carried at the lower of cost or market. Obviously, if that is the case, where the market value is lower than the cost, we're going to end up losing money on any units that we sell during that time frame. So obviously, if this is happening consistently, you're probably going to go out of business. So this should be a rare occurrence, or if it's not, your business is probably in trouble. Let's assume that Smart Touch Learning paid $3,000 for some inventory. By December 31st, that inventory is only worth $2,200. We will adjust the $3,000 debit balance in inventory by crediting it for $800, bringing the balance to $2,200. The debit for the adjustment will be to cost of goods sold. It is crucial that the ending inventory amount on the balance sheet is correct. If it is incorrect, it will have a domino effect on several other numbers, making them incorrect also. Let's assume that Smart Touch Learning reported ending inventory at an amount $5,000 higher than it should have been reported. The ending inventory is overstated by $5,000. This violates our conservatism principle. However, when ending inventory is overstated, that also means that cost of goods sold will be understated, leading to both gross profit and net income being overstated. Next, let's assume that Smart Touch Learning reported ending inventory at an amount $1,200 lower than it should be. When the ending inventory is understated by $1,200, cost of goods sold will be overstated, leading to both gross profit and net income being understated. There are a few ratios that relate to inventory and are helpful in assessing the company's overall financial health. The first of those ratios is inventory turnover. This is a measure of how frequently a company has to replace its inventory. Knowing this frequency will help to establish how much inventory to purchase and how often we need as a business to place new orders. The days in sales inventory is a measure of how old inventory is. We compute it by dividing the number of days in a fiscal year by the inventory turnover ratio. This ratio will tell us the age of the inventory, which is of particular use when we handle inventory that has some type of expiration date.